So just yesterday, it felt like the market was stuck in this really weird place. This whole bad news is good news thing.
Right. Weak data meant the Fed might cut rates.
Exactly. Everyone cheered bad news, but then overnight, it just flipped completely. That whole logic got turned on its head. It makes you wonder, what on earth happened?
It really was a dramatic pivot, and that's what we're going to unpack for you today. We're taking a deep dive into the latest Tactical Market Intelligence report. This one covers the U.S. market outlook for July 3rd, going into the 4th, 2025.
Okay.
And our mission here is really to clarify some of these, well, often conflicting ideas you hear about investing, shine some light on this complex shift, and hopefully give you some concrete strategies and a clear perspective.
Yeah, think of this as your shortcut. We want to cut through the noise, turn that confusion into clarity, maybe give you a few of those, aha moments. So let's just jump right in. Okay, let's really dig into this reversal. Because for weeks, it was all about weak data being good, paving the way for a July Fed cut, right? That was the narrative.
Deeply entrenched, yeah.
So what was the single piece of data, maybe, that really broke that mindset? What was so impactful?
Well, it wasn't just one thing, more like a confluence, but the big one, definitely the June jobs report. Non-farm payrolls came in at 147,000,
Okay.
which was, quite a bit higher than the 118,000 expected. And maybe even more surprising, the unemployment rate actually ticked down to 4.1%. It was 4.2 in May.
Huh. So stronger jobs. But what about wages? Wasn't that the inflation fear?
That's the crucial part. Average hourly earnings, they moderated, only up 0.2% for the month. Year over year, that kept it at 3.7%.
So not too hot.
Exactly. It kind of eased those immediate wage price spiral fears. It's nudging closer to what the Fed might consider, well, comfortable.
Right, the Goldilocks zone for labor, maybe? Strong enough, but not inflationary.
Sort of feels that way, yeah. And it wasn't just the jobs report. The Atlanta Fed's GDP Now estimate also got bumped up slightly for Q2 growth to 2.6%.
Okay, so reinforcing the strength idea.
Precisely. And then there's the Federal Reserve commentary. Things Powell and Bostic said recently. Before, it sounded like we'll wait and see. Now, the market's reading it as more hawkish.
Like Powell saying he's carefully watching the labor market.
Exactly. Or Bostic calling for patience. Suddenly, that doesn't sound like someone about to cut rates. It sounds like we're holding steady, higher for longer.
Okay. So you've got stronger jobs, decent GDP forecast, Fed talk sounding tougher. How did that actually change the odds for the Fed's July meeting? Can you put numbers on that shift?
Yeah, we can model that using a Bayesian update. Think of it like adjusting your bets in poker as new cards are dealt. Each piece of data changes the probabilities.
Makes sense.
So the chance of a hawkish hold, meaning the Fed keeps rates right where they are, 4.25 to 4.50%.
Yeah.
That probability surged. It went from about 30% before this data dump to 70% now.
70, wow.
Big jump. So the market's now betting they hold tight, focus on inflation. The neutral pause scenario, acknowledging some weakness, but still pausing. That dropped from 50% down to 25%.
And a cut.
Yeah.
A dovish surprise.
Almost off the table now, down to just 5% probability from 20% before. The futures market basically evaporated the chance of a July cut, went from nearly 24% odds down to less than 5% right after that jobs report hit.
That's a massive swing in just, 24 hours. So how did the market actually react? What did we see on the screens?
Swift and decisive. The S&P 500 jumped 0.8%, new record close at 6,279.35.
Okay.
The NASDAQ 100, your tech index, led the way, up a full 1%, another record, 20,601.90. Even the Dow gained 0.8%.
So a broad rally, but was it just everything going up? Or was there movement underneath?
Oh, definitely movement underneath. A really sharp sector rotation. Money poured into tech and growth. Think names like First Solar, Enphase, Cadence Design, CrowdStrike. They did really well.
And the losers.
Rate-sensitive stuff got hit. Home builders, for example. Lennar, D.R. Horton Sharp, declines there.
So the market rallied on good news. That's the flip right there. What does that tell us about what the market's really afraid of now? Has the monster under the bed changed?
I think that's exactly the right way to put it. The primary fear has shifted. Before, strength was bad because, oh no, the Fed will stay tight. Now, the fear isn't really the Fed's stance anymore. It's recession. It's the fear that a slowdown will absolutely hammer corporate earnings.
Oh, okay.
So that strong jobs report, it kind of pushed back the recession fear, at least for now. And the market seems willing to say, okay, Fed, you can hold rates steady as long as the economy is strong enough for companies, especially tech and AI, to keep delivering on earnings.
So the risk focus moved. from Fed policy to earnings delivery.
Precisely. The locus of risk has transitioned. It's all about whether companies can meet those expectations now.
That really clarifies the shift. But it's not just about the big picture, is it? It's about digging into specific stocks, understanding why they're moving based on, like, first principles.
Absolutely.
So let's get into some key names. Starting with the big one, NVIDIA. NVDA. It really feels like the barometer for the market's whole attitude towards AI and growth.
Yeah.
Just hit $3.92 trillion market cap. You could almost feel the FOMO, the fear of missing out, can't you?
Oh, it's palpable. And when we run simulations looking at different types of traders, the short-term path still seems to point higher for NVIDIA, maybe towards that $166 resistance area. Momentum guys are still buying dips.
Wow.
But the simulation also shows a growing chance of a really sharp, volatile reversal right around that zone. That's where the profit takers might meet the short sellers.
Looking at the numbers, short interest is incredibly low, like 0.88%.
Meaning this isn't a short squeeze driving it up. Not at all. It's just pure buying pressure. Which is powerful, sure, but also makes it fragile if conviction wavers. Options are interesting too. Lots of call buying short term, like a 66% bullish skew, but the overall open interest put call ratio, more balanced, around 0.91. And the max pain price for July 18th options is down at $130.
$130, that's quite a ways down from where it's trading, like gravity pulling it.
It can sometimes act like that as expiry gets closer, yeah?
Okay, let's unpack this a bit, because what's really striking here, you've got this insane parabolic rise, huge bullish sentiment in options. And then you see heavy insider selling. High-level execs, CEO included, selling hundreds of millions worth of stock at these all-time highs. I mean, that feels like a massive red flag, doesn't it?
It's definitely a contradiction you have to pay attention to. Insiders selling that heavily. Well, it raises questions.
For sure. Now, speaking of contradictions, let's talk Apple. While NVIDIA's flying, Apple feels like the struggling giant in the tech space. It seems like the biggest disconnect among the mega caps right now.
It really is. The sentiment around Apple is just dominated by this FUD cycle, fear, uncertainty, doubt. And it's driven by very real legal and competitive pressures.
People always worry about Apple, but what makes these issues, like, truly threatening compared to past challenges? Is it different this time?
That's a fair question. I think the DOJ antitrust lawsuit is the big one. It directly targets the App Store, the core of their incredibly profitable walled garden. That's not just a slap on the wrist, it's potentially foundational.
Right, hitting the business model.
Exactly. And then you layer on these new class action lawsuits about them allegedly misrepresenting Siri's AI capabilities.
Yeah.
It just feeds this narrative that Apple's maybe losing its edge, becoming a laggard.
And the chart reflects that.
Yeah, technically it's clearly struggling, trading below its 100-day, below its 200-day moving averages. Indicators like MACD and RSI are kind of neutral, not showing strong momentum either way, but the volume-weighted average price, the VWAP, is bearish. It's basically stuck in a range. Resistance around $206, then maybe $213, $214. Support down at $197.50, and then $193 is pretty crucial.
So what does this all mean? You've got this titan of the market, so central, but facing really significant headwinds. It's a real battle playing out there.
It absolutely is a real tug of war. Now, let's pivot completely. A bearish counterpoint to all this tech excitement. Decker's Outdoor, DD4. This one felt like a real canary in the coal mine recently. What exactly caused that collapse? And could it be, maybe, a false alarm for the broader economy? For Deckers, the sentiment just went straight to fear and panic. The trigger was the company suddenly withdrawing its full-year financial guidance.
Whoa, why?
They explicitly cited uncertainties related to U.S. trade policy and tariffs. That signals massive operational uncertainty. Investors hate that.
Can't blame them.
And then Goldman Sachs piled on, initiating coverage with a sell rating and a $90 target. Boom. Stock dropped 20% in one day, and it's been weak since.
Ouch. And technically.
Overwhelmingly bearish. NVDA is deep negative, showing strong downside momentum. The RSI Relative Strength Index is neutral-ish, around 43, but importantly, it's not oversold yet.
Meaning more room to fall.
Potentially, yes. And it's trading way below all its key moving averages, 20, 50, 100, 200 day. As for a false alarm, while the direct link to trade policy makes it feel pretty real, it's a concrete sign that these macro issues are biting some companies, even if tech seems immune for now.
A stark reminder. Okay, shifting gears again. Palantir, PLTR. This one feels like it's sort of graduated from maybe a meme stock to something with real momentum. What's this dual-engine growth story people talk about?
You're right. The narrative around Palantir has definitely shifted. It's less meme, more actual, greed and FOMO based on performance. That 80% surge this year, it's fueled by two things.
Okay.
First, their commercial AI business is exploding. U.S. revenue from their AI platform, AIP, jumped 71% year over year. Enterprises are adopting it fast.
Wow, 71%.
Yeah. And second, they still have their original moat, the government and defense contracts. That's resilient income, especially with the global uncertainty. Quantitatively, short interest is low, lots of call option buying, strong institutional ownership. It looks solid on the surface.
But there's always a but, isn't there?
There usually is. The crucial point here is valuation. The stock's trading around, say, $134. But the average analyst price target, it's way down at $104.94.
That's a big gap.
It's a huge gap. It signals that Wall Street, professionally, sees significant downside risk. It warns that maybe the excitement, the FOMO, has pushed the price way ahead of the fundamentals. Potential for a correction if that narrative stumbles.
That's a really key detail to watch. Okay, one more Nutriband, NTRB. This one just screams speculative hype cycle, doesn't it?
Yeah.
What is driving this microcap's insane moves? And is that dividend structure something you see often?
Nutriband is almost completely detached from fundamentals right now. It's pure hype, pure greed, driven by a few key things happening quickly. First, it got added to some Russell indexes.
Index inclusion, forced buying.
Exactly. Passive funds have to buy it. Second, this really unusual 25% preferred stock dividend. The catch. It only converts to common stock if the FDA approves their aversive fentanyl product down the line.
That is unusual. Tying a dividend directly to a binary FDA outcome.
It's quite novel, yeah. Very direct way to try and drum up speculative interest. And then you add in the structure. Tiny float. Only 2.64 million shares tradable, and insiders own over 70%.
Just super volatile.
Extremely. Our AI simulation gives it a 75% chance of a short-term momentum pop, completely ignoring fundamentals. But there's also a 20% risk of a sell the news crash and a 5% chance of just some random negative event. It's pure musical chairs.
You definitely don't want to be left standing when the music stops on that one. Okay, let's try and tie some of this together. We're seeing conflicting signals everywhere. Apple is the perfect example, right? Strong negative fundamentals, but the stock isn't exactly crashing. So how do you resolve that? When fundamentals scream sell, but the chart just sits there.
It's one of the toughest challenges, honestly. And Apple is textbook. You have the DOJ suit, this huge multi-year threat to their core business model. You have the new lawsuits about AI promises. You have insiders selling heavily. That's all fundamentally bearish. But then you look at the chart, it's not in free fall. It's stuck, consolidating sideways between, say, $193 and $213. Key indicators are neutral. It's like a stalemate.
So the narrative, Apple is invincible, is clashing hard with these new structural threats.
Exactly. And this fundamental versus technical tug of war, you see it everywhere. Understanding how it plays out, like we're seeing with Apple, is really key to navigating tricky spots.
Okay, so using our tree of thoughts framework.
Yeah.
How do we map out the possibilities for Apple here? What are the paths?
We see three main scenarios. Path A, the bearish fundamentals finally win out. The stock breaks below that $197.50 support, then $193 and starts a real downtrend.
Okay, breakdown.
Path B, the technical stalemate continues. The stock just keeps chopping sideways in that range, frustrating for everyone until some new catalyst forces a move.
Range bound.
And Path C, the broader market, maybe led by NVIDIA, just keeps ripping higher, and it pulls Apple up too, despite its own problems. The rising tide lifts all boats scenario.
Right, so where do you lean? Based on everything, what's the most probable path?
Well, applying that Bayesian logic again, the most impactful recent news is that DOJ antitrust suit getting the green light to proceed. That feels like a really heavy long-term weight.
Structural headwind.
Exactly. So our conclusion is that the most likely near-term outcome is Path B, sideways consolidation. It might stay stuck for a while, but we have a strong bearish tilt. We think the eventual resolution is more likely to be Path A, breakdown.
So sideways for now, but probably breaks down later.
That's the assessment. Those negative fundamentals just seem too significant to ignore long term. We'd put maybe a 65% confidence level on that overall Path B leading to Path A sequence. The biggest risk. Just a crazy market melt-up that ignores everything for a while.
Got it. Okay, let's make this really practical. What does this all mean for your portfolio listening right now? How do you take these insights and turn them into an actual plan?
Right, that's the goal. We use what we call the action plan matrix. It helps rank these ideas objectively based on things like catalyst clarity, trend strength, risk versus reward.
Okay, let's hear the rankings.
All right. Top of the list, highest conviction, is actually a bearish one. Ducker's Outdoor, DEC.
Bearish. Highest conviction, why?
The fundamental catalyst that guidance withdrawal tied to tariffs is crystal clear. The technical trend is strongly bearish. It's a well-defined setup. The pro for you, trading with that strong trend, clear risk levels. The con, it's already dropped a lot, so you have to watch for potential oversold bounces. Timing matters.
Okay, DEC key bearish. Next.
NVIDIA, NVDA. High conviction, but short-term bullish momentum. It's riding the market's strongest trend right now. The pro is obvious, ride that powerful wave. The con, extreme valuation, that air pocket risk is real, especially as it nears resistance. You need an exit plan.
Got it. Ride the wave, but know when to get off. What's next?
Apple, AAPL, medium conviction, bearish. The fundamental headwinds, especially the legal stuff, are really strong. That's the pro for the bearish case. The con, as we said, it could be dead money stuck in that range for ages or even get dragged higher by the market before the fundamentals bite. Requires patience.
Medium conviction bearish on Apple. Needs patience. Okay.
Then Palantir, PLTR, medium conviction, bullish. Strong momentum, great narrative in AI, dual engine growth. That's the pro. The con, that valuation gap we talked about. Analyst targets suggest it's stretched. Vulnerable to profit taking? Be careful chasing it here.
Medium conviction bullish on Palantir. Watch valuation. And the last one.
Nutriband, NTRB. Lowest conviction, highest risk, bullish play. This is pure speculation, the pro. Potential for a huge quick pop because of the low float and catalysts. The con, extreme risk. It could collapse instantly with zero fundamental support. It really is musical chairs. Know your exit before you even think about getting in.
Wow. Okay. That matrix really helps frame the thinking. So just to recap the big takeaways today, we saw this massive paradigm shift in the market, right? From bad news is good to good news is good, driven by that changing fear from the Fed to recession risk.
Exactly.
We saw how fundamentals and technicals can clash, like with Apple, and how important it is to have a plan, like that matrix, to navigate it all.
Absolutely critical.
But before we wrap up, I want to leave you, our listeners, with a few more thoughts. Things to really chew on. First, that double-edged sword of economic strength for tech. Yeah, a strong economy helps earnings. But higher rates for longer should pressure those sky-high PC multiples, shouldn't they?
Yeah.
The market seems to be ignoring that discount rate problem for now. How long can that divergence last?
Good question.
Second, NVIDIA's concentration risk. As it gets bigger and bigger, index funds have to buy more. It feeds itself. But doesn't that make the whole market incredibly reliant on one single stock? What happens if NVDA stumbles? What does that do to everything else?
A significant systemic risk building there, potentially.
And finally, that canary in the coal mine signal from Deckers and maybe Centene too. While tech seems untouchable, real-world macro risks like tariffs are hurting other companies. Is this pain going to spread? Is there a broader slowdown creeping in that the market's just not seeing yet because it's so focused on AI?
Things to watch very closely.
We really encourage you to take this kind of critical thinking and apply it to your own research, your own decisions. And look, if you want the fastest, most frequent updates to stay on top of these incredibly complex, fast-moving dynamics, make sure you subscribe to the Deep Dive. You really won't want to miss what we uncover next.